Good day, ladies and gentlemen, and welcome to our class on Bollinger Bands. And today we're going to be discussing one of the best and most unique indicators that's actually placed right on your charts. Now, I would appreciate it if you could subscribe to my YouTube channel. Just go down below and click on the bell icon or the subscription button, because it's very important for me to have subscribers. And we won't bother you. We'll only send you out a message whenever I post a new video. So now, Bollinger Bands were created by John Bollinger, who is very, very well known throughout the financial markets. And he's been around a very, very, very long time. Now, of course, Bollinger Bands were not developed for online trading and forex trading. He originally developed these for stock trading for professionals. But John Bollinger is still around with us today, and you can actually go to his website at www.bollingerbands.com and learn directly from the horse's mouth. Because there's a lot of information in the internet about Bollinger Bands and its discretionary theories, and most of it's about individual gurus or strategists or traders trying to tell you their system on how to use Bollinger Bands. Okay? And there's many good interpretations. Now, we're going to look at the bands in a minute, and they're made up of three basic lines: a simple moving average band, and an upper and a lower band. Now, Bollinger Bands can be applied in all the financial markets, including equities, forex, commodities, and futures. Bollinger Bands can be used in most time frames, from very short time periods to hourly, daily, weekly, and monthly. So it's one of the best indicators for the type of trading we do. CFD and short-term forex trading, we need indicators that respond to short-term price movements, or we can use easily in 5 and 15-minute charts. Now, Bollinger developed his bands to answer one basic question: are prices high or low on a relative basis? In other words, if we know that the price of the euro-US dollar is trading towards its low on its overall basis, we should be looking at a buy. If it's trading quite high, we should be looking at a sell. But it's defining it on a relative basis, not on the last year, not on the last month, relatively to where it is at the moment. Now, Bollinger Bands are a technical analysis tool. Specifically, they are a type of trading band or envelope. They provide relative definition of high and lows that can be used to create rigorous trading approaches in pattern recognition. Bands are usually thought of as employing a measure of central tendency, such as a base. And here we employ, for Bollinger Bands, we use a 20-period moving average as our base. So Bollinger Bands consists of a middle band, which is a moving average, and an upper and a lower band. These upper and lower bands are set above and below the moving average by a certain number known as standard deviation, thus incorporating volatility. Now, the general principle is that by comparing a security's position relative to the bands, a trader may be able to determine if an asset is relatively low or high on a relative basis. Further, the width of the bands can be an indicator of market volatility. Okay, so where do we start? Now, I don't say it's so boring, but we have to get through the basics. And that is very, very important. We have to understand what Bollinger Bands look like on a chart and how they're placed on our charts before we can understand how to read them. But then we have to figure out and understand where these lines on our charts come from. So what you're looking at is a Bollinger Band on my teaching chart. This is the euro-US dollar 1 hour chart. And across the center, you can see the brown band, or the brown line, which is a 20-period moving average. Okay, this is the basis that Bollinger Bands is developed. Then we place above and below a band at what's called 2 standard deviations above and 2 standard deviations below. And here's where it gets a little complex, understanding what a standard deviation is. And you have to know it, but you only have to know it this one time. After this, you'll never have to calculate it because it doesn't quite involve calculation. But when we calculate these and we place them on our charts, we get an upper band and a lower band. So the upper band is placed 2 standard deviations above the price, and the lower band is placed at 2 standard deviations below. So they're basically the same distance from that center band. Now, the shape and the size of the overall pattern of the Bollinger Band doesn't tell us anything. Sometimes it looks like a dragon, sometimes it looks like a snake, sometimes it looks like a space alien. There's no analysis on the pattern or the character of the Bollinger Bands, except when the Bollinger Bands are wider, the market is more volatile. When the Bollinger Bands contract, the market is contracting and has less volatility in it. So that does help us a great deal, because when the markets are contracting and not volatile and prices moving up, you have a pretty good non-random market. Okay. But it helps us explain the market. So now we have this squiggly thing with this upper band and lower band and this center moving average. Okay, this is Bollinger Band. Like I said, the center, the movement, the upper band or the lower band, that's all we really talk about, are 2 standard deviations from the middle band. And I keep saying this word standard deviation. Okay, and you're going to have to understand it. Okay, like I said, you'll never have to deal with it again. But interesting, in the real world, no statistician would ever calculate standard deviation by hand. The calculations are involved and they're somewhat complex. And of course, there's a risk of mistakes. So this is why statisticians rely on spreadsheets and computers. Now, standard deviations was never developed for the financial markets. It's developed for general analysis. It is used by statisticians in all types of computations, in all types of industries, for lots of information. Now, standard deviation, and please, this is a little bit complex, a little bit boring. I'm going to try to make it as easy as I can, and then we'll never get back to it. Standard deviation is the measure of the dispersion of a set of data from its mean. So let's back that up. Standard deviation is the measure of the dispersion, the distance between the open, the high, the low, and the close, which is your set of data, from its moving average. So if you were to look at a candle and you see there's a low, there's a high, you have a candle and you have that kind of a width, it tells you something about the market. Well, standard deviation and the calculation tells you something about that data set, because the farther it is, if you take the average price and the farther that high is from the average price and the lower that low is away from the average price, what do you have? You have a lot of deviation. Where if the candle made it had a big body, but the open and the high and the low and the close were relatively close together, that means you have a very small set of deviation from the data set. And then it is used in conjunction with the mean. So how far is this calculation or the dispersion? Say the euro was trading at 122, closed at 123, but it had hit 125. It had fallen as low as 121. So what is the dispersion of that whole data set? Those 4 numbers, how diverse and how dispersed are they? And when you calculate them in and figure out their dispersion, how close are they to the moving average? Now, it is calculated as the square root of the variance by determining the variation between each data point relative to the mean. So we take the open and compare it to the mean. We take the close and compare it to the mean. We take the high and compare it to the mean, and we take the low and compare it to the moving average. If the data points are farther from the moving average, there is a higher deviation within that data set. And don't you think that's an important piece of information? That if you knew that even though you had the close, which was the average down here and moving average, but your data set, your highs and your lows, or your highs we're continuing far away from that average, that tells you something about what's happening in the market. So in its simplest form, the mean is simply the average of the data points in a given set. In investing, for example, you might want to know the mean closing price for the last 20 days. This can be obtained by what? Adding the closing prices for each session and dividing by 20, a moving average. So now we have these all on our charts. So we have our upper band, our lower band, and our moving average. Now, price should, as it is moving up, stay and move on that upper band. When price is moving down, it should stay near or close to that lower band. And this is called riding the bands. But in this case, or in all cases with Bollinger Band, the moving average is a crucial determining factor. See, like here, we see price moving up steadily, 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 steadily. We see price pushing outside the band, trying to stay in the band. At a given point, price gets rejected by that upper band, and price falls down. Okay. So when you get rejection from that upper band, it's telling us that that trend might be in trouble, that upward movement. But as long as it stays above the moving average, we're not in trouble yet. Then you see price here try to recover, and it breaks out of that upper band. It comes to that upper band and then can't sustain that upper band, gets rejected. And look at what it does. Once it breaks that moving average, it tells us that uptrend is over. Not in trouble, but it's over. And we go into a downtrend. Okay. Again, we see it with the lower bands, and it bounces off those lower bands. And again, now it moves back and breaks above that moving average and moves back into its uptrend and then rides those bands again. And you can tell a whole story on this price by watching the relationship to those bands, the upper and the lower band, the involvement of the price and the rejection of the price, and how those prices are constantly trying to reach the upper or the lower band, and its reaction at the moving average. And this is what Bollinger Bands is all about. So by default, the Bollinger Bands are set at 2 standard deviations. And so we're looking for it to ride the trend. Okay. We're looking at the relationship of the candles to the upper band. We're looking at the relationship of the candles to the moving average. Okay. And we can see here, Bollinger Bands contract during a sideways moving market, and they widen during a volatile market. But we're looking at the outer bands. We don't care about the background and, like I said, the width of the band, the shape of the bands. Okay. We care about the relationship of the upper and the lower band. We care about the volatility of the markets, and we care about its interaction with the moving average. So we know Bollinger Bands is based on the moving average and the upper and the lower bands. So now let's translate that into price action. So Bollinger Bands are a great indicator, and they work very well with other indicators. And so here I'm going to share with you a little presentation on a simple Bollinger Band strategy. So find the currency that is moving in an uptrend or a downtrend. The currency must fall back from the uptrend and touch or almost touch the bottom band. The currency must fall back from the uptrend and touch or almost touches the bottom band. Once the price hits the lower band, look at the RSI indicator, and it should be between 30 and 50 and be rising. Once this happens and the price hits the lower band and RSI is going upward, make an entry when this occurs. Take a stop loss below and a take profit above your bands. And this is a nice little Bollinger Band trading strategy. So Bollinger Bands are a great indicator to use in any market. When you combine these with the RSI indicator, it should give you great entry and exit points. Sometimes, or something else you consider, is when the price touches the middle band, you can make a second entry to press your winners. This can potentially give you double the profit. So with this strategy, we only use the one trade that we made initially. But if your rules allow you to make multiple trades at a time when the currency pair, then adding a second position at the middle line may be something you want to consider. But Bollinger Bands can be used in many ways once you've understood and able to interpret and read the bands and how they move with the upper band and the lower band and their relationship to the moving average band. So thank you very much for joining us. Have a great trading day, and come back and learn more about Bollinger Band strategies in our more advanced classes. Thank you very much, and we'll talk to you again real soon.